Very good evening to everybody. We are going to start our discussion, continue our discussion on the financial statements which we had started last week. Last week we have started discussing the statement of financial position. So, we had discussed in the last class the share capital, retained earnings, non-current liabilities. Current liabilities we need to discuss. I have told you that we will be discussing after our discussion regarding the non-current assets and the current assets. Today we are going to discuss non-current assets first. Hope you are all able to hear me properly, right? Are you able to hear me properly? Okay, fine, fantastic. Okay, fine. Fine. So if you just look into this schedule, non-current assets, we have tangible non-current assets, intangible non-current assets, and long-term investments, which is mentioned. We are first going to discuss the concepts of tangible non-current assets, intangible non-current assets. Tangible and intangible. Let me discuss first about the tangibility of a non-current asset. Non-current asset is something which is to be used in the business on a longer time basis. More than that, the assets which we are going to use on a longer time basis will be giving the organization back the benefits over the period of its use. That means organization can expect a long-term benefit out of these assets. That is why we refer it as non-current. Rather, in earlier balance sheets, we used to refer these elements as fixed assets. Fixed assets are those assets which are expected to give long-term benefits. Here, we refer it as non-current asset. Under this non-current asset, we are going to discuss tangible non-current asset. The terminology tangible talks about physical existence, physical quantifiability, and physical measurability. Means, I will repeat again, tangible non-current assets are those which are having physical existence, which can be quantified physically, which can be measured physically. Very important. So here we have physical existence of the asset. The asset which is having the physical existence can be measured physically. We can have a quantifiability physically, and hence we refer it as tangible non-current assets. And no doubt, tangible non-current assets are expected to fetch the business a benefit over a longer period of time. All the assets what we are talking about as tangible, other than land, every element will be having a stipulated useful life. Based upon the useful life, those assets are expected to fetch benefits to the business enterprise. The useful life will be on a longer term basis. For example, building can be used for 50 years, certain machineries can be used for 20-25 years, some equipments can be used for 15-20 years. So the number of years which the organization technically feel that asset can be used in the business is referred as the useful life. And for every tangible asset other than land, there is useful life. For land, no useful life is assigned as per accounting. Why? Because land never ever is destroyable. When we talk about intangible non-current asset, in contrary to the tangible non-current asset, the terminology intangibility talks about the fact that it is not physically existing. It can't be measured physically and it can't be quantified physically. But the benefits arising out of the same can be felt over a longer period of time. So, as in the case of the tangible non-current assets, in the case of intangible non-current assets as well, we are going to feel the benefits over a longer period of time. So, the common factor which is going to tie a knot between this tangible and the intangible non-current assets are nothing but the feelings related to the long-term benefits. Even in the case of the tangible non-current assets, we can feel the benefits over a longer period of time. And in the case of intangible assets, non-current assets as well, we can have a feel related to the long-term benefits. So, these long-term benefits are common so far as tangible and intangible non-current assets are concerned. These two assets are otherwise referred as capital expenditure as well. Why do we refer it as capital expenditure? There are two types of expenditures: revenue expenditure and capital expenditure. Revenue expenditures are those which can bring in benefits to the business enterprise in a shorter span of time, or we can say that we can feel the benefits immediately. There is no long-term impact. As in the case of capital expenditure, we are going to feel the benefits over a longer period of time. So, the tangible non-current assets and the intangible non-current assets can otherwise also be referred as capital expenditure, which are brought to the balance sheet. Now, we need to understand the terminology expenditure. An expenditure is something which is expected to fetch a benefit to the business enterprise. Any expenses, if it is qualified to be referred as expenses, any element, if it is qualified to be referred as expenses, that is expected to bring in a benefit to the business enterprise. The benefit can be on a short-term basis, the benefit can be on a long-term basis. So, any expenditure which is expected to bring in benefits within the shorter span of time is eligible to be referred as revenue expenditure. So, any expenditure which is resulting in a long-term benefit to the business enterprise can be referred as capital expenditure. So, the main feature of the expenditure is nothing but it is going to result in a benefit to the business enterprise. Now, when we talk about the expenditure, it has got one more important feature, very, very important feature, other than the feature whatever I have told you just now. The other important feature is nothing but the fact that an expenditure is something which needs to be brought to the statement of profit or loss at some point of time. It can be now, it can be later, but compulsorily, if we treat something as an expenditure, that must be recognized in the profit or loss account at some point of time. all the revenue expenditures are recognized in the statement of profit or loss immediately, because that is going to result in the revenue in the shorter span of time. If you incur an expenditure which is considered to be a revenue in nature, is expected to give rise to a benefit in the form of revenue immediately. So all those expenditures which are quantified or qualified as revenue expenditure are straight away taken to the profit or loss account at the end of the year, during the year in which we have incurred such an expenditure. But in the case of capital expenditure, we are not taking the same to the statement of profit or loss account immediately. Rather, the moment we incur such an expenditure, treating or considering the long-term benefits arising out of such an expenditure, we take straight away those expenditures to balance sheet under the head non-current assets. I am specifically talking about tangible non-current assets and intangible non-current assets. So, okay. So the tangible non-current assets and intangible non-current assets, since we are categorizing it as capital expenditure, because it is referred as expenditure, this need to be brought to profit or loss account at some point of time, even though right now we have classified it under the non-current assets in the balance sheet. How are we going to bring these two elements in the statement of profit or loss account? Let me talk about the tangible non-current assets. Tangible non-current assets, once again repeating what I have told you some times back, tangible non-current assets are nothing but a kind of capital expenditure incurred by the business with an expectation in generating long-term benefits. The benefits specifically, if we try to talk about, means revenue. So the tangible non-current assets, either directly or indirectly, everything are expected to contribute towards revenue. So that is why all these tangible non-current assets are used directly in the business. This tangible non-current asset, say for example, a machinery. This machinery is tangible in nature. We have procured the machinery now. The same machinery is to be used, say for example, the useful life is 15 years. Value of the machinery is 1.5 crores of rupees. This particular machinery is expected to fetch us the benefits over 15 years of time technically, because the vendor, when he is supplying this non-current asset, this machinery to us, would have had a technical evaluation regarding its utility. Accordingly, he would have given us the total number of years as 15. That means prima facie the asset can be used for 15 years, and the money what we are going to spend for the same is 1.5 crores of rupees. So 1.5 crores of rupees is expected to fetch us benefits over how many years? 15 years. That means for the next 15 years, whatever revenue which we are planning to generate, no doubt this 1.5 crores of rupees is going to contribute. That means every year the amount what we can match with the revenue is 1.5 crores divided by 10, which is equal to 15 lakhs. That means if you are going to split this 15 years yearly, the expenditures are also supposed to be split yearly. Sorry, I made a mistake. It is not 10 years, it is 15 years. So 1.5 crores of rupees is to be split for how many years? 15 years. Every year we are going to match the expenditure against the revenue to the extent of 10 lakhs of rupees. So every year 10 lakh rupees out of this 1.5 crores is expected to fetch as the revenue. So if it continuously is going to fetch as the revenue, This 10 lakhs every year must be matched against the respective year's revenue for how many years? 15 years. So we are going to do that as per the principle of matching. Now, this 10 lakh rupees, when we talk about the principle of matching, we all know pretty well, every expenditure shall be matched against the revenue generated for the corresponding year. Here, out of this 1.5 crores, we are going to understand the fact that this is going to help us in generating revenue for 15 years. So 10 lakh rupees every year must be matched against the revenue generated for that specific year. So this 10 lakhs out of this 1.5 crores of rupees must be brought to statement of profit or loss every year as an expense. This